Hello, everyone. Thank you so much, Hansi. It was a wonderful session. And, it reminds me of a book I read that Warren Buffett invests like a girl. So, this really establishes that women as investors, as personal finance professionals, as board professionals, as asset allocators are naturally gifted and definitely in no way less than men, if not more. So, it was really insightful. And, now with this, we move towards a class that's new to investing and has made all the buzz during the COVID times. So we'll talk about millennials, how millennials invest, the challenges they face, how different they are from the previous generation. And what's great is uh, you guys got the perfect moderator. I am a millennial, and on an everyday basis, I hear problems, challenges, psyche of the millennials and how they invest. So I'm really excited because the challenges are different. There's too much noise. When I started 10 years ago, there was hardly any noise. If you had to learn investing, there all the sources were actually foreign sources, few good books written by foreign authors. Maybe you could read blogs on Warren Buffett, but nothing much. In the last 5 years, specifically in the last 2.5 years, uh, information overload. There's noise around this. And this is where I believe we influencers are also to be blamed. So I am Pranjal Kamra, founder of Phenology Ventures Private Limited. I started my journey from YouTube, and I believe YouTubers, Instagrammers, Finfluencers, as we are now being called, also share the blame in confusing the investor. So it started on a good note. It started on trying to simplify finance, but there's too much of it. Everywhere you find financial content, and there's just too much of it. So I'm really excited to host this session because the panel is absolutely amazing. So in this session, joining us will be Mr. Adil Shetty, CEO and co-founder of uh, Bank Bazaar. And trust me, I'm a fintech entrepreneur. A platform like Bank Bazaar is every fintech entrepreneur's dream venture. So, I'm really jealous of you, Adil, here. Uh, you know, uh, we also have Mr. Ravish Naresh, again, CEO and co founder of Khata Book. And I tell you, I'm really jealous of this panel. The kind of products they have built, scaled. I think a substantial quantum of retail GDP is actually logged through Khata Book. And that's some achievement, that's some achievement. We also have Mr. Harpreet Singh, CEO and founder of Insider Lab FinTech. And, this is again a business that helps unorganized players in the financial sector to inject financial technology in their business and be able to stand and compete in this digital technology infused world. We also have Mr. Chanchal Khandelwal, fund manager and senior analyst from Aditya Birla Mutual Fund. And again, an AMC that has set standards on how to scale the asset management business. So really great to have this panel. I'm really honored, to be hosting and discussing this with you. I'll start with you, Harpreet, here. The difference that I see between this generation and the way previous generation invested is that millennials, young investors, they accept risk in a more acceptable manner. I talk to my father, I talk to our parents' generation. They wouldn't move out of gold, retail, real estate, or FDs. Stock market, the first thing they would say is gamble. And I see current generation suddenly in the last 2 years, even stocks are conservative for them. They think crypto is the game. Stocks. Oh, I see people, millennials saying, I'm a conservative investor, thereby I invest in stocks. The most aggressive one is crypto. So how do you see this shift?
So, uh, I would like to say in that front, in most psychological models, humans are believed to act upon a pleasure principle. So, the pleasure principle is basically the driving force that compels human being to gratify their need, wants, or urge. So, there is no doubt that this generation have come a long way from fixed deposit and gold, but simply buying the dip is not the be all and end all investing. So millennial is a person who has born between 1980 to 2000, someone who is 20 to 40 years of age. So this is a segment that is now redefining India's financial success story. People in this age are in this age group makes up to 46% of the Indian workforce and contribute to 70% of the household income. So millennials have recently turned the rules upside down, as you were saying, especially when it comes to investing. They have there have been number of demat accounts that has been opening, but as you are rightly said that they are more towards the cryptocurrency and the new fancy things that have been coming in. So millennials are hunting for returns, which is driving risk hunger in investing in India. An impatient Indian investor class, largely driven by the millennials, is leaping into a riskier investment from peer-to-peer lending to cryptocurrencies in the hope that boosting returns rocked by one of the most inflation rates of Asia. So millennials spend beyond their means, and this often leaves them broke by the month end. And saving is the last thing that comes onto their mind. And perhaps in keeping with this, 60% of them are first time investors. Again, women rule the roost, investing twice as much as male counterparts. So, more than 60% of the transactions of investments are coming from tier 2 and tier 3 cities. When it comes to investing preferences of the young guns, they prefer mutual funds, they prefer equity, and lastly, in gold. So, the major thing that they want to invest is that can give them the instant gratification so that they can earn soon. So I think that they should know what the risk factor is, what the risk appetite is, how much risk they can take, and then they should decide where to go and where not to, because they have 20, 30 years of good earning capacity that is ahead of them. So if there was a time to take some risk, then this is the time. But they should not go on a random basis that they should go for any investment. If they are a first time investor, they should not go for cryptos, because if your risk appetite is very less and you cannot afford to lose your money, let's say you have 10 lakh rupees and you cannot afford to lose it in a month, then you should not go in crypto. Then you should go for a safe investment. And if your risk appetite is such that you don't care if your 20 lakhs also go, then it is diversifying your portfolio. So as per your affordability to take risk, you should decide that in which kind of investments I should go.
Right, right. I'll ask you to jump in, Ravish. Here, so what Harpreet said is absolutely fine. But sometimes I think that, is it because millennials are conditioned differently, or is it because technology allows them to delve quickly into various asset classes? So I don't know if 20 years ago you could invest paperlessly in stocks by downloading an app, whether the previous generation would have acted the same way. So, do you think, Ravi, that this generation is looking for instant gratification and impulse investments, or it's just that technology allows them, and thereby we as humans are naturally attracted towards quick investing and looking for quick returns?
Um, okay, firstly, thank you for having me here. I think it's definitely the latter. Human, tendencies mostly remain the same with whatever generation we are in. I think it's just what has changed over the last 10 or 15 years is that through internet there is now accessibility. And also there has been a revolution in payments. So you can very easily link up your bank accounts to trading platforms like Zerodha and instantly start trading. And I think that is what has fundamentally shifted this accessibility of ease of trading and ease of also gathering information you yourself. And that is what has truly shifted the game for millennials versus the previous generations. Also, I think like new age markets like cryptos, which are now 24/7, like at least market ended at 5 p.m. before. But now these new age markets 24/7 is like an all day, all night gambling going on. So I think the main shift has been truly around the accessibility, which has driven all this interest from millennials.
So thank you, Ravi, so much for not blaming us millennials and shifting the blame to technology. I feel guilt free. Thank you for not blaming finfluencers. I feel liberated. I would ask you, Adil, to jump in here. There's been a lot of regulatory uncertainty, and I'm sure you are no stranger to it, around the faith of cryptocurrencies in India. Recently, RBI made an informal announcement, or tried to nudge people in saying that it will favor a ban on cryptocurrencies. But last couple of years, rampant advertisement, all kind of crypto apps coming up, Bollywood, actors, celebrities endorsing crypto apps. A lot of first time investors have actually started their journey by investing in cryptos. With this uncertainty now, with one app, almost pausing its operation, ED raids on another one, a lot of fear is there. Existing crypto investors, specifically first time investors, what would you say? What will be the right course of action now?
Yeah, good question, Pranjal. I think at Bank Bazaar, right, we've always tried to present the data basis which we then, suggest what could be the right course of action. Now, let's look at the data first behind your question. So, with crypto, firstly, we have a asset class which is volatile, right? So, we've seen over a 50% fall on multiple occasions. It's definitely an asset where, a certain kind of highly sophisticated investor with a small portion of capital may be looking at, but it's a very volatile asset and everyone has seen it play out. This is something we've been saying for years. The second point is the finance minister in her budget has clearly said that the taxation will be at the 30% range income tax level. Now, consider this and compare it with an index equity mutual fund. If you hold it for over a year, you're getting taxed at long term capital gains, which effectively is 10%. So, where's 30%? Where's 10%? And thirdly, you yourself highlighted the compliance issues, right? So the RBI has said that it's not very supportive. There's been no explicit ban. The court judgment exists. So it is still a area which is in flux. I would say millennials, please tread with caution. I think the blockchain is very valuable. I think we'll find long-term use of it, but it's not something that you should blindly rush into, because the point remains that I think Ravish made a great point about technology. Today, technology has made it frictionless. But the point is, right, the risk return profile of investments has not changed, right? You get into it knowing what your risk is, what your return is, and you need to be cognizant of that. The message I want to leave you with is tread with caution when it comes to cryptocurrencies.
Right, Adil. Very prudent. I mean, I'm sure a lot of investors. I wish, I pray that they follow this. They deal with cryptos with caution and do not treat it blindly as the next revolution that's going to go a 10x, 100x. Chanchal, I was waiting to talk to you because equities is what I know, and equities I can't resist talking about. Last 2.5 years, 3 years, a lot of IPOs came in, and we have a platform where we compare the demat accounts, and we actually noticed that whenever there was an IPO coming, a lot of new demat accounts were opening, and LIC IPO, Paytm IPO, Zomato IPO, a lot of demat accounts were opening in that duration. Historically, is that the trend, or it's just that millennials have the FOMO factor much more ingrained in them, or that's always the case? Bull runs, more IPOs, more demat accounts, and once the market settles, they go away.
Sure. Hi. Thanks for the question. I think very interesting point you mentioned. What has happened in last 2.5 years, and when the market has been good, and a lot of people have entered the market, specifically from the millennial side. A lot of people I have seen who have never been invested have entered into the market. But if I were to take a step back, and Adil rightly pointed out, uh, in equity investing also it's about being aware of the risk, where millennial probably uh, may get it wrong is that they are just investing by hearing the buzz in the market, and people like you, Pranjal, play a very important role where you teach them where to invest, how to invest, and what not to invest in. I think the most important thing, and the saying goes very much, is that equity investment is all about cash flow and cash flow and cash flow. And people who look at businesses from a longer term, and people who are able to identify the trend and catch them early, will be able to make a decent money. The good part of these IPOs are, many of these IPOs come at a point in time where the J curve is just starting. Let me take a step back and talk about few successful IPO. I remember Jubilant Foodwork, which is Domino's, which listed in India almost 10 years back, and the J curve in quick service restaurant was just starting. Someone who had invested in that would have made a humongous money maybe 5-6x, if not more. Persistent technology listed in India almost 12-13 years back and has gained tremendous tailwinds from the sector they were present in. So some IPO from the right sector, if you're able to catch up early, you'll make a reasonable money. But just investing
Any
blindfold
recent
in the IPO,
example? Any recent example,
yeah,
Chanchal?
sure.
Because 12 years ago, I was not even born.
So recent example would be, for example, if I were to catch a trend early, a campus footwear recently got listed. Zomato and Nykaa recently got listed. The reason I talk about these three companies are campus footwear is trying to catch up the trend of athleisure and trying to catch up the trend of the informal footwear, which is a trend which I think will play out in next 5 to 10 years. Nykaa is catching a trend on personal care spend of the Indian millennial. Millennial today are online and they're spending a lot on online. So that's where I was surprised yesterday Nykaa reported the number. The BPC, the personal care, saw a huge amount of tailwind, and the AOV is 1,800 rupees close, and there is a huge amount of number of customers entering into that segment. The third company I talk about, Zomato. All five of us sitting here would probably use Zomato once a month, if not more. So all these three new companies which I spoke about, if you're able to catch up the trend early through IPO, also you'll be able to make humongous money. But you have to be aware that some IPOs are for the trend, some IPOs get listed. If the cash flow is not good or if the cash flow of the company is not strong, we should be very careful to exit at the right time or let professional investor like us invest for you.
Right. Essential interesting. You mentioned that most of us use Zomato once a month. As soon as you said that, I, for myself and for all the millennials on behalf of them, I was saying once a day at least. So that's how much, I see
Zomato,
people using. Yeah, sorry. Go on.
if Zomato team would hear that, they would be laughing at it, and the stock would be rocketing. It. That's what they are trying to increase the frequency. The frequency of people using Zomato. If that improves, Zomato would be one of the most profitable company. That's what they're working upon.
Right, right. Right. So you mentioned about campus going into informal clothing, footwear, and I realized I really need to scale my startup to be able to afford shirts and blazers. I look really informal here right now, so I'll be scaling my startup much more seriously from now onwards. Coming to you, Harpreet, again, because we're talking about millennials, we have to go back to cryptocurrencies. And when we deal with assets like equities, there's always different ways to play that out. In a very aggressive manner, investing in small caps; in a very passive manner, investing through hybrid funds or large cap index funds. So you can adjust your exposure to equity through various options that's available. But when we talk about cryptos, we blanketly term it as really really risky regardless of time frame. Whereas equity, we always talk about if your time frame is good, it's less risky. If your time frame is less, it's more risky. So we don't talk about time frames while investing in cryptos. We say it's risky, and at times we paint all tokens, all coins with the same brush. So I think at times, do you think we on the other side, who have seen the financial market much more than young investors entering the market, we also kind of paint an extreme picture of cryptos by saying no, they are extremely risky? Where do you stand on this?
I think I would stand on that part, the affordability of loss. If you have the backup in your mind that I am an investor who is a millennial and he has a time of year of investment for 20 to 30 years, as blockchain is a new technology into the system, the technology is flourishing and you have seen many good technologies built up on blockchain, and crypto is just the one token that Bitcoin has given to us. So if I talk about the technology, it itself is robust technology. Every big company, every MNC is using it to fold in their future. And if I talk about crypto, as it is a new bubble for many people, and if we see last week, there were more than 400 billion worth of investors that were completely wiped off, and many Indian investors were also affected. So if I think about, if I have to say something about crypto, crypto is a thing. If you think that I can invest for good 7 8 years going from now, as it is a new technology, then that is an investment to keep for. And if you think that it can give me an instant gratification for, and I invest 10 lakh rupees and it gives me 15 in a year or so, or in 6 months, then that is a wrong investment to go for, because there are many rules, there are central authorities that are, it is not immune from the government, and there can be many manipulations that can be done. So till the justification is given, till there are new things that have been coming to this technology, till that time we should wait and we should reset our budget and define our goals, what we have to, what we want to achieve from these kind of investment. If it is for a long term investment, then we can go for it. And if the investment is just for the short term, a year or so, then I don't think then that crypto is the new thing to go for at least 1.5 years from now.
Just my opinion on it, I think I should share it here. My problem right now with cryptos is, you say something like a Bitcoin. When we talk about Bitcoin, it doesn't have any intrinsic value. Say it doesn't have an EPS, a yield, a dividend, a rental yield, nothing. So it's very difficult for me to actually calculate its intrinsic value. And the counter argument from the pro Bitcoin camp is it's similar to gold in that sense. So gold is limited in supply, so it derives its value from being limited in quantity. So Bitcoin apparently can only be mined up to 21 million coins, and most of it has already been mined. So limited supply gives it value. But my thinking on that is, just being scarce or just being limited in supply is not enough. Gold is not valuable because it's limited in supply. It's valuable because it has proven itself over the last 5,000 years as an indispensable, insubstitutable store of value. Tomorrow another metal cannot jump in and replace gold. The problem with crypto or a particular token, be it Ethereum, Bitcoin, any coin, is that it has not proven itself to be indispensable. It has not established itself as the default platform of transactions or as store of value. So till that happens, in my opinion, it's more of speculation rather than investing in a calculated asset class. But yeah, just my opinion. And we talked about the most risky asset class. Ravi, I would ask you to jump in, and we switch the pendulum. We talk about the most conservative asset class now, the old, boring deposits. Sounds very preachy, parental advice kind of a thing, but I remember in my childhood, my mother and my father would boast about that when you turn 18, we have done this recurring deposit for you, and you would get this much of amount. And parents, relatives, grandparents were really proud of this habit, that if you're doing FD, you're being really, really responsible. I think the narrative has changed now. I mean, FDs, it might happen that, if you want to create wealth, defeat inflation, FDs are not the best way. There are other asset classes, but I think, and we are partially responsible for it. I think the narrative has changed, where if you invest in FD, it's being told that you are not financially prudent, you're not disciplined, you're not taking care of your finances. So I think, what is your opinion on this? I think we are dealing with extremes here, and I think sometimes we influencers also, in order to be highlighted, and I'm being brutally honest here, in order to stand out of the crowd, we want to change the narrative. So if everyone says FDs are cool, we come on camera and say, see, this is the Excel sheet, these are the reasons why FD is not cool, and our video goes viral. So do you think this change in narrative is justified, and do you think FDs are being irrationally marginalized?
So I think it is fair to say that having your complete portfolio in FDs definitely is not a good hedge against inflation. I mean, at the end of the day, inflation is definitely greater than the interest you get from FDs. That said, like as our parents, and I think to be honest, this comes from personal experience, like having burnt hands as a day trader, like investing in risky
You
options,
need to
risky.
watch my videos, Ravish. You need to watch my videos.
No, I think I agree. I think let me just complete. So I think
Sure.
where millennials like me, initially go wrong, um, is when we sort of absorb advice from the internet, and I would say absorb this incomplete information from the internet, from platforms like yours as well, and then try to have their own theories and try to make their own incomplete understanding of the market and act on it. I think investing from a millennial perspective should be very simple. Like our parents, I know there is definite. I believe like there is definitely power, and there is definitely like logic in the power of compounding, and safe assets where you can continuously invest, like SIPs or FDs, or even gold. And to be honest, even though they don't sort of give you as much return, and may not be as best inflation hedges, they're definitely, I would say, in longer term, when you're compounding them, they're definitely a safe asset class that gives you compounded returns over time. So in that regard, I think the fundamentals of the investing don't change, even though the market dynamics for, or the availability of investment options has changed for millennials. So I think in that regard, FDs should form a certain portion of your portfolio that is sort of risk free. Also, I think beyond FDs, definitely there are other safe asset classes. So for example, I definitely believe over the last couple of years I've started investing in ETFs, exchange traded funds. They are I feel they're a little superior than even mutual funds, because they carry lower fees, etc., and they track the index. There's one more stat that I came across recently, that top 20 companies of in India account for 70% of the entire profit pool. So the and Vanguard also sort of I would say scaled up index investing in US. And if you see over a longish period of time, index investing and ETFs generally give a very safe and a very inflation hedged return over longer term. So I think the investing in and diversifying across these safe and, I would say, mindless asset classes, where you can just invest, you let your money compound and let it be risk free, basically, is the way to go. So I think FDs definitely does form somewhere in that portfolio, because most of them are sovereign backed. So they are even in terms of like turmoil, or when a country goes down, they're still like relatively stable compared to stocks. But I think they should form some portion of your portfolio.
I'm glad you said that, Ravish. I'm glad. I kind of see this narrative where, everyone who invests in FD, even certain part of it, are considered, you're investing in FDs because you don't know other asset classes. So I'm glad you said that they still form an integral part of overall asset allocation strategy. And, you brought the point of sovereign backed, and which is the key here, that, you don't invest in FDs looking at higher yield, because in fixed yield instruments, higher the risk, higher the returns. So sometimes, we are trapped with cooperative banks, smaller regional banks in lure of higher yield, which is not the right way to invest in FDs. There has to be a balance, safety first, because if you're anyways going for risk, there are other asset classes available. FD is safety first, returns second. So I'm glad you said that they are part of a balanced portfolio. Adil, I want you to jump in. Let's talk about the next most boring investment instrument available, passive funds, index funds, passive ETFs. You know, Again, the same perception. And, I'll say, even I have turned around my opinion. 4 years ago, I was not a fan of passive funds. I believed that, in India, there still penetration is low. So fund managers actually have this scope to find out inefficiency, mispricing, and generate alpha and defeat the market. But I think since SEBI reclassification, specifically with large caps and mid caps, where only top 100 companies by market cap classify as large caps, and a large cap fund up to 80% of its assets, it has to invest there. I think the through active funds, the ability to generate alpha in mid cap category and large cap category, in my opinion, has reduced drastically, which makes ETFs and index funds, passive funds, more relevant. What's your stand on index funds?
Yeah, so Pranjal, at Bank Bazaar, we are very fond of and highly recommend index funds. So I am going to go with what Ravish has said, that these are funds which track the Sensex or the NSE, and we have an expert like Chanchal in this panel. I think Aditya Birla has some good index traded funds. Now let's look at the data, right? And I'll share a couple of data points, and the user can decide for themselves. So the first thing is, if you look at a developed or sophisticated market like America, the passive funds are 16% of the overall market and are actually larger than managed funds, which are about 14% of the market. And obviously, this can change over time, but clearly, index traded funds are doing well. Now, the automatic counter question we get, right, is okay, what has been the 5 year return or what has been the 3 year return on these index funds? And then again, right, the challenge we face, right, Pranjal, as a person who's trying to demystify and explain finance, is the 5 year or 3 year return is a rolling number. So it can change every quarter depending on when we speak. But usually, if we look today at a 5 year return, we're talking about something north of 12%. Now, the advantage of the index fund is the same advantage that equity mutual funds have. If you hold it for a year, the unit goes under long-term capital gains. So instead of paying 30% tax on an FD, you're now effectively paying 10% depending on certain circumstances if you're holding over a year. So I think if I on my savings or the savings I'm building for my daughter, if I can generate over 12% and I can pay 10% tax on it, I would be really happy over the next 10 years. So, yes, I would highly recommend index funds.
Right, right, right. I'm again glad you said that. I think with specifically with SEBI classification in certain categories, it makes a whole lot of sense. I like to take Chanchal's opinion here. Two questions actually. One, a follow up to this. You know what I've experienced in the last 3 years is that unicorn, well funded, investment tech platforms, they really push passive funds because it kind of removes the advisory layer and makes it a completely tech first product, whereas AMCs still hold active funds to be really really relevant. So where do you stand on this, and where do you see how much will passive funds eat into the share of active funds in say a decade or so?
Sure, Pranjal. Thanks. Now let's take a step back and look at how the passive fund started. Now in US, or where there is a mature market, where the industry's GDP is growing at 2-3%, and where the companies are growing at 7-8%, which is a good growth from their perspective. But we are in a country like India. A GDP per capita is $2,000. 65% of population is less than 35 year of age. We in this forum are talking about millennials who are higher risk taker. The India growth, the companies who are doing well in India can grow at 15 to 20%, and not just for 1 year, 3 year, 5 year, probably a decade. In this kind of market we are present in, the construct mindset that it's all about active fund. Passive fund is a learning we learn from developed market very fast. It's a trend which we follow from hearing people what people that globally talk about. But India is all about active fund today. At least when the GDP is going 7-8%, good companies will grow at 15-20%. Better company can go at 25 to 30%, and not just for 3-5 years, but from a decade perspective. So I am all about active investing. The other part which I would just like to add to the discussion, which I just saw you guys coming, I mean, millennial people less than 35 years of age, I think 80% of investments should go into equity, various form of equity, mutual fund, VC investing, startup investing, wherever they can, and whatever the risk profile allows them. I think the Indian market is in such a sweet spot that if they are able to invest rightly for 10 years, they are going to make money out of investing. The fund which I manage, the Birla Gen Next fund, it's about next generation fund. I try and capture the story where next generation will go and spend. So we own recent amount of QSR, we own Mall, we own Nest Tech company, and that's where we try and identify the trend. So the answer to simplify what I've said is all about active investing, greater allocation to equity, and compound your wealth for next decade. And it's for you to be select the right fund to invest in.
So active investment across categories, be it large cap, mid cap, small cap, or more of multi or flexi across categories.
I would say more of multi and flexi. Large cap,
Right.
probably after a company reaches a certain place, the growth can be at 13 to 15%, but mid cap, small cap can grow strongly. So flexi multi cap has to be active investing. Others probably, I mean, I come from a mutual fund platform, but I would say can some part go to large cap ETF? It can probably, because sometimes it's difficult to do active investing and capture some stories which you can't capture. That's where passive investing comes in.
Oh, absolutely. I'm so happy you said that. My two favorite categories in active investment is flexi and multi, because that actually gives the fund manager to actually show his skill and pick out mispriced opportunities. In certain categories, the hands are too tight to actually be able to generate alpha, but multi and flexi absolutely has to be active. Another trend along with passive that India is catching up to it, ESG funds. So could you explain that to our viewers? I think literacy around that is still low, and where does that fit in a holistic asset allocation strategy?
Sure, Pranjal. I think ESG. Let's understand what is ESG all about. I mean, it's a misgoverned concept, or people don't understand ESG investing. ESG is about environment, social, and governance. So governance is always was always there as an investment portfolio manager. You always look at good quality, good government company where the promoter are good. They follow a discipline on capital allocation. They follow a discipline on creating a moat of the business, creating a successful business. So that governance is already there. Now, environment and social. Now, people, specifically millennial, are more conscious about the environment and social aspect of and rightfully said, because if you don't if you hurt the environment today, my kid or the millennials kid will not be able to enjoy the world as much as you and I are able to enjoy. So someone who is investing in say a electric vehicle, someone who is investing in something which is degenerating plastic and focusing on environment friendly, those investment will always succeed, because as a consumer of those, I will give a higher weightage to someone who is able to tell me why they are doing what they are doing, right? So millennials of today are more aware. They are there in the tech platform, in the social platform. They talk about things happening, and where the consumer habit changes, that's where the fund has to change, and that is where some funds are just focusing on ESG investing, because by nature, if a consumer habit is changing to identify companies who are able to catch the trend, those companies will grow much superior over longer term. If those companies will grow superior because consumers are trying to identify people who are talking about future and talking about good trend in the environment, those will succeed, and that's where ESG fund is trying to pitch in. The fund will invest only in the sector or places where companies are more focused on sustainability, on environment, on governance, and that's where these companies will succeed over longer term.
So I invest in ESG out of my consciousness, out of my ethical and moral thought process, but not necessarily as a means to, I shouldn't look at ESG funds that are better in terms of financial returns than a multi-cap or a flexi-cap fund. That's not the right way to look at ESG funds, right?
So by nature, Pranjal, I'm trying to say ESG fund may give a. I'm saying may. I'm just emphasizing ESG fund may give a better return than multi and flexi cap fund, because what will ESG fund do? They will try and invest in company or more ESG compliant, and if a trend of consumer habit is shifting to a ESG compliant companies, that means that lot of if today I am a ESG compliant company, let me think of example. For example, I am a EV company. If people are moving from a petrol to a EV vehicle, that means that the EV vehicle will grow faster. If a company grows faster and throws a decent amount of cash flow, the stock price will reward them, and stock will give a higher return. So by nature, a ESG company over longer term can give a higher return because consumers are moving to that direction, and companies will grow higher, and the cash flow generation will be higher, and the profit growth will be higher. So there are two aspects to it. One, if I am ESG as a person, I'll invest in ESG fund, and probably ESG fund by nature can give a longer return over longer period, may give a better return than even flexi and multi cap. If environment moves faster, the pace of movement of the environment has to be captured. The trend is for sure there, but we'll have to see how fast this trend moves on.
Oh, nice perspective. I mean, I never thought of ESG funds this way, that it makes sense purely from the financial standpoint, personal finance standpoint as well. So nice perspective. I'm sure it's a huge add on to our viewers. With this, we come to the end of our discussion. Unfortunately, there are time constraints. Thank you so much, gentlemen, for adding value. It was really insightful. I had a great time moderating it. I'm sure you had a great time. And I'm sure viewers had a blast. It was really, really value edited for them. Thank you so much for taking your time out. And it was a wonderful session. Thank you. With
Thank you.
this,
Wish
I
you
would
all
ask.
the best to all the panelists. Thank you, Pranjal. Thank you, everyone. Bye.
With this, I would ask Gautam to take over the mantle and continue with the next session. Thank you so much. This is Pranjal Kamra signing off.